Welcome back. Now, so we probably all know by now, hedge funds got beaten up pretty badly last year. But managed futures, though, did relatively well. One of the few bright spots in an otherwise very grim investment environment. Now, managed futures have been around for decades for big institutional money, but now they're gaining popularity with savvy retail investors. We sat down and talked with Aaron Smith from Superfund about what you need to know.
A managed futures fund is simply a diversified pool of futures products. So everything from stock indexes, interest rates, currencies, that's about half of our portfolio. The other half of our portfolio consists of energies, metals, agricultural products. I mean, basically everything from soybeans to rice to Japanese yen to DAX futures. It's an incredibly diversified pool. But the key thing about managed futures and why we're able to be successful in the long run is the fact that in any of those markets we could be long or short depending on the trend. So managed futures is one of those few investments that can actually profit when the market is going down.
So it kind of sounds a lot like a hedge fund, though.
I think it's similar to a hedge fund strategy in the sense that it's very flexible and that we can make money in a very dynamic way, not just when the market is going up. On the other hand, I think it's very different from hedge funds because, number one, the correlation of managed futures funds to all other alternative investment strategies is quite low. And number two, managed futures is a very highly regulated asset class.
But at the end of the day, though, does it not boil down to strategy, how you run your funds?
Absolutely. And what we do is we trust our investment strategy to a system. Everything we do is fully systematic. And think about it. How can you process over 100 markets worldwide? We use a computer system because we think that this is a much more efficient way to crunch all the data that there is out there.
So what you're saying is this is quant stuff. This is systematic program trade, black box.
That's right. It's purely systematic, and the advantage of that is that you take out all the human emotions out of the trading process. So, for example, in a bull market, investors tend to get overconfident or greedy. In a bear market, they tend to panic or get too scared. But the system doesn't have any emotions. It just follows the discipline that has proven itself over quite a long period of time.
And Superfund, or your super funds, not just did well last year, did very well last year when just about everybody else got killed.
Well, yes, our Superfund A was up 35% last year, Superfund B was up 50%, and our most aggressive trading strategy, Superfund C, was up about 74% just for the year. But more important than that, Martin, is the long-run performance. Managed futures since 1980 have outperformed stocks, bonds, real estate.
All right, but what about this year? Are managed futures going to make people money this year?
Well, it's not about the short term. It's all about what you can achieve over the next 2 to 3 years. And I think over the next 2 to 3 years, managed futures will be a winning strategy. I can't promise what we'll do in 3 months or 6 months, but I can say that all this global uncertainty will lend itself to very strong trends. And we don't care at Superfund if those trends are up or if they're down. Just as long as there's clear trends that we can follow in the market from a technical standpoint, then we can profit for our investors.
If you were hit with big losses in 2008, however, perhaps it's time to consider adding managed futures to the mix. And Brennan Lothery talks us inside one of the few investment home runs of 2008.
While most investments swung and missed in 2008, managed futures were a hit. Managed futures funds are similar to hedge funds. They're run by commodity trading advisors, or CTAs, who attempt to capture trends by going long or short futures contracts in a variety of markets, such as energy, metals, livestock, even sugar. Last year, the trend was a friend to the managed futures space. As other investments tumbled, the average futures fund returned more than 14%, according to Barclay Hedge.
Maybe it's the fear that drives a lot of the markets in crisis periods, and that tends to create trends, and that's where we really capitalize.
What's amazing is this group hasn't posted a down year since 1999, having handily trounced the return of the stock market this decade.
We believe it solidified a rightful place in people's portfolio, and we believe that people can see the wisdom and the advantages and the diversification that it all offers.
One of the most respected names in the managed futures business is John Henry, the owner of the Boston Red Sox. His main fund was up 91% last year, and he's about to launch another Ken Webster is the president and CEO of John Henry & Company. He says managed futures have a place in every investor's portfolio.
And you look at something where you mix a managed futures allocation into an overall portfolio of stocks and bonds, we're able to significantly lower the overall portfolio's drawdown. We're able to lower risk of the overall portfolio and increase returns. And that's something that not too many asset classes actually can say.
CTA managers like John Henry are hoping investors continue to think managed futures are a hit. Brendan Lothry, Bloomberg News.
Managed futures, meanwhile, are displaying their lack of correlation to the equity market. According to data from Barclay Hedge, CTAs are actually down 1.3% through August.